What's up guys, my name is Josh Paveo and I've been trading and analyzing NFP for almost 7 years. So in this video, I'm gonna share with you my 3-step framework that I use anytime I'm trading high impact data. And then what I'm gonna do is we're gonna plug that framework into this week's NFP and I'm gonna give you my expectations. I'm gonna analyze NASDAQ, I'm gonna analyze gold, and I'm gonna talk about the US dollar. So if you trade any of those, this should be very helpful for you. Then I'm gonna give you my entry checklist. What are the things that I look at in terms of actually taking an entry after the data comes out? Now for the data that we have coming out this week, we have 2 pieces of data that's really important. Even though a lot of the attention always goes to NFP, we also have something coming out called unemployment rate. NFP, non-farm payrolls, this number is a measurement of the labor market. It measures the amount of new people who are getting put onto payroll. So if we look here on the calendar, we can see that the forecast is 110,000. What this number represents is that they're expecting 110,000 more people to be added onto payroll from last month. Now, the second thing that we have coming out is the unemployment rate. This is pretty much telling us the opposite, right? This is telling us the percentage of people who are out of work, but they're currently looking for work. And the reason the labor market matters is because the Federal Reserve is constantly watching the labor market to help them make their decisions on what to do with interest rates. If NFP is coming out higher, like the labor market is really strong, we have a lot of demand for workers. What happens is this is typically inflationary. Reason being is that when you have a ton of demand for workers, that means you have employers competing for employees. So that's going to increase the cost of things because when businesses have to increase how much they're paying their employees in order to attract employees, they need to raise the cost of things to stay in business. Second thing that happens is that when you have a ton of people working, you also have a ton of people spending money because they have money to spend. So this increases economic activity. So as the labor market gets stronger, the demand for pretty much everything also goes higher. As the demand for everything goes higher, so does the cost of things. So this is how we see inflation start to trickle up because of the labor market. And the opposite is true too. Typically when the labor market's getting really weak, this can be considered deflationary. And the reason being is the exact opposite. People stop spending money. People start saving money and they stop going out all the time. The prices of things go down because the demand of things also goes down, right? So when you're trading this data, you don't want to ask, how do I think NFP is going to impact NASDAQ? The question that you want to ask is, how do I think NFP is going to impact rate expectations? Because when you understand rate expectations, you're going to understand the direction of the market. So as a general rule of thumb, higher interest rates is typically going to be bad for NASDAQ, higher interest rates is bad for gold, and it's good for the US dollar. But lower interest rates does the exact opposite. Lower rates are good for NASDAQ, good for gold, and usually bad for the US dollar. This chart right here is interest rates and it represents where they were at that time. So if we take a look at this here, 2020 all the way to 2022, we had 0% interest rates. We're at like 0.5. So we're just going to call this low interest rates. Now, what was the dollar doing? We take a look at the dollar here. This is the dollar, gold, and NAS. The dollar was dropping. Low interest rates is bad for the dollar. Gold was pushing up. Low interest rates is good for gold. And NASDAQ was pushing up. Low interest rates is good for NASDAQ. So this is a low interest rate environment. You can see the direction of the markets. If we take a look back at this chart, March 2022, right over here, this is our first interest rate hike. And then we continued for about a year. So if we take a look at March 2022, compare this, right? You have dollar, gold, NAS. This is all low interest rates. And now when I click over, you see them all change direction. This is 2022, right? You see the date right there. Now the dollar is gaining strength. The dollar's bullish. Gold is now bearish. It's dropping to the downside. And NASDAQ is now bearish. It's dropping to the downside because high interest rates is bad for gold, bad for NASDAQ, and good for the US dollar. So this helps give you your bias long-term when you understand what interest rates are doing. I'll take it one step further and show you the chart one more time. Towards the end of this year, towards the end of 2023, what happens when we stop hiking rates and we start pausing rates? After pausing rates, the next step is to cut, and that's where you see the drop, and the markets know that. So the markets start acting like, even though we paused, they start acting like we're about to start cutting. So let's take a look at 2023. So the dollar dropped because of the pause in rates. Gold started consolidating and then taking off. This was a combination of the pause in rates, cutting rates, and also the Israel-Hamas war started about right here. Now, NASDAQ is pushing up very aggressively, right? It's bullish for NAS. We start pausing and cutting rates, we flip directions again. So if you look at this one more time, low interest rates, dollar dropping, gold consolidating and pushing up, NAS pushing up. High interest rates, Dollar flips, it's pushing up, gold's dropping, NAS is dropping, and then this is when we pause and start cutting. Dollar drops, consolidates, gold consolidates, flips back to the upside, NASDAQ immediately flips back to the upside. So these rates determine the overall direction of the markets, and the data like NFP is what determines where interest rates go. So this is why data like NFP or CPI is so important for the markets, because we have to know, is it going to impact interest rates? So this is the three-step framework that I use every time I'm trading any piece of high impact data. And it starts off with expectations, because without knowing expectations, you can't move on to the next step. You gotta know what the markets are expecting, so that way you can say, if this data comes out above expectations, like a surprise higher or a surprise lower, is this going to change the bigger picture, right? So this is a three-step process that I'm gonna walk through as I do analysis for NFP. So let's start with expectations. The markets are currently expecting 110,000 for new people to get put on their payroll. One of the biggest things that I don't have in this cheat sheet that I wanna point out is that we also have unemployment rate coming out. It's really important to pay attention to this, because even though I'm just gonna give you analysis and talk about NFP, you want to make sure unemployment rate ideally comes out opposite. Let's say they both come out higher. If NFP comes out higher, what does that tell us? Strong labor market, right? If unemployment rate comes out higher, what does that tell us? Weak labor market. So if you get two pieces of data telling us two different things, usually we get really messy price action. If they both come out higher or they both come out lower, technically that's considered mixed data. We're expecting 110. If the data comes out above expected, what that's telling us is that we have a stronger labor market than what was priced in for, right? This most likely is not going to change interest rate expectations. The labor market right now is not the source of inflation. So if this comes out above expected, honestly, I don't know that I'll be taking any trades on this. I think the direction will be very random. There's a chance we get a drop to the downside on both of them. If that happens, I mean, I'm bullish on NAS, so I'll just be looking for a pullback for buys on NAS, because I don't think higher NFP can really justify downside on gold, downside on NAS. A stronger labor market isn't bad for the stock market. A stronger labor market isn't going to raise interest rate expectations. If you go back and look at like 2022 when the Feds were raising rates, right? Remember that chart I just showed you guys? You will find on the days that NFP came out higher, the markets actually did start pricing in more rate hikes. And NASDAQ dropped, US 30 dropped, gold dropped, dollar gained strength. Like all of that played out, and it continued. It wasn't just a little spike. We're not in that environment right now. So in my opinion, I think if this data comes out higher, the market reactions are gonna be very risky. It doesn't mean you guys can't take a trade when it comes out. If you take a breakout and get some volume, cool. Just be careful and protect your entries, because this is one of the riskier trades to take. It's most likely not going to follow through and continue once we get the reaction. Obviously, I'm not a psychic. I have no idea what's going to happen. Trading is all about probabilities. So this is just a low probability trade to take. Now, what I believe the higher probability trade would be to take would be this one. If we see this data, NFP, come out lower than expected, this should be good for interest rate cut expectations. A weak labor market is the number one thing that the Fed said they do not want to see. If we see the labor market getting worse and worse, they've already said that they're willing to take action and cut rates. So if this data comes out lower, this should be good for rate cut expectations. Now, interest rate cuts, like I just showed you before, is good for gold. Rate cuts is good for NAS, rate cuts is bad for the dollar. So if NFP comes out lower, there is a higher probability that the markets start pricing in rate cuts, and I would actually expect to see, if I see NAS pushing up, I'm taking a trade there. Now, I'll cover what I look at for entries, but the first thing is you want to understand the higher probability direction based on the markets, and that's what this cheat sheet is for. So whenever we have high impact data, I always create these cheat sheets and I go over it so that way I can prepare for the data ahead of time. If you guys want to trade NAS with me, especially for this NFP print coming up, I do it live every day. I'll put the link in the description below. There's a free trial. You can come check it out and you can get this analysis live, and you can also take the trades with me when NFP comes out. If you guys want to join me, I'll put the link below. So the last thing I want to cover with you is, what do I look at for taking entries? These three things actually are rules of mine. These are things that I've come up with based on the last 7 years of getting my ass kicked trading economic data. The number one thing that I look for when data comes out is volume. I need to see volume when the data comes out. And the reason being is because if you don't see volume, that tells me that the markets don't care about the data. So if I'm sitting here and I'm like, okay, NFP comes out lower, I'm looking for NAS to push up. If NFP comes out a little bit below expected and NAS just kind of does whatever it was doing as if the data never came out, I'm not taking those buys. Even if NAS pushed in the right direction, if I don't see volume, in my opinion, it's just a risky trade. I like taking trades that have higher probability chances of playing out. So volume is number one. Number two, direction. I used to make this mistake all the time. I need to see the markets go in the direction based on my analysis. If I'm expecting NASDAQ to push up when NFP comes out lower, because that's good for rate cuts, if NFP comes out lower but NASDAQ drops, I'm not taking any trades. I'm not gonna get sucked in and say, oh, I should just take the sells because maybe my analysis was wrong. I used to do that all the time. Data would come out and I'm like, well, I'm expecting gold to do this or NAS to do that. And then NAS would do something different and I would take the trade anyways. 9 times out of 10, I ended up taking a loss and the trade that I wanted to see and the direction still ended up playing out. It just gave like a pullback first, or I had to let the volatility die down first. The first candle or the first entry or the first sign of volatility and volume isn't a reason to take a trade. Not when you understand how the data is going to impact the markets long term. I don't want to be in the high volatility. I want to be in high volume. To me, there's a big difference. Volatility is when you have this back and forth bullshit, but no direction. Volume is when we have a breakout and we continue. I want volume with direction. I don't want volume without direction, right? So the direction is very important to me. I will only take a trade in the direction with volume based on my analysis when the data comes out. And the third one, also, this is something that I had to learn from my own mistakes, is I will only take the trade if I can get a good entry placement. Let's say volume is there, right? Cool. Let's say the direction is there. Let's say NFP comes out lower, NASDAQ pushes up, I want to take buys. But for some crazy reason that none of us can explain, when the data comes out, NASDAQ pushes up and opens 1,000 ticks away from where the candle just was. I'm not taking that trade. I don't care how good it looks. Because if I enter up here with that kind of volume, the smallest pullback on a candle like that can be 300-400 ticks and it can blow your account or it can hit your daily loss limit. And I'm not willing to do that. If I don't get a good entry placement, and even if these other two are in line, I'm just gonna let this candle close, see if I can get a pullback, and I'm still gonna look for a trade in that right direction, but I have to use good risk management. Like, risk management doesn't go away just because I understand how to trade high impact data. You have to be careful with high volume. You have to be careful with this stuff. So I hope this video was helpful for you guys. I'll see you guys in the next one. Take care.